Afternoon, everyone. It's really a pleasure to be here at Strathmore University today. I'm so glad that you've all come, and we also thank your Dean, Dr. Jenga, for inviting me here today for hosting the event. For me, it's a great chance to share some views with you, and I hope that in doing so, I can set the stage for a really good discussion of the many subjects that I think will be interesting for us to talk about. It is a changing world. Let me begin by responding to Dr. Jenga's comment about rights and the changing face in Africa. We are believers at the IMF that if a government sets a really good framework, that people won't have to know what the IMF is, they won't have to know what monetary and fiscal policy is. They'll live in a country, in a society, where there's financial stability, where there's a private sector that can be vibrant, can create jobs, can create incomes for people. And I think something we'll come back to, I think, in the discussion. Africa is poised at a point where it doesn't have to go down the path that other countries have followed for development, because technology is changing, and there will be opportunities for all of you as educated business students to go out and help your country leapfrog. Somebody told me the story the other day about how his wife goes to their bank once a week, and their son doesn't know where the bank is because he never has to go to the bank because he does it on his electronic device. Things are changing, and you don't necessarily have to do things the way that they've been done before, and that's the opportunity Africa has. But let me, I have some views I would like to share with you. As I say, I think they'll help it'll give you a sense of what our thinking is and will help set the stage for an interesting discussion. As was just said, Africa has just experienced 15 years of remarkable economic growth and development, something that really didn't seem likely. I was here in Kenya in 1982 and 1983, and it didn't seem likely that Africa as a whole, Sub-Saharan Africa, would experience that kind of a growth spurt. These considerable economic achievements have transformed Africa, and it's given, I think, an important new hope for the region. However, in the last year or so, we've seen the whole outlook darken. For some countries, particularly as external developments, recent economic success. What I'd like to talk about, I'd like to start out talking about today are these recent developments, starting with the significant gains since the 1990s, but then also outlining the reasons behind this recent slowdown and asking, what does it really mean? Finally, I'd like to highlight how Africa can continue to grow with sound economic policies and a favorable medium-term prospect. My message is pretty simple. Sub-Saharan Africa has come a long way in a very short time, and there's every reason to believe it can continue growing and developing if it follows the right policy approach. But let's begin what's been called Africa Rising. After 1995, this region has experienced strong growth and an impressive improvement in social and human development indicators, not the eradication of poverty, but a lot of progress. More than 2/3 of the countries in the region enjoyed 10 or more years of uninterrupted growth, which had not happened before. Millions of Africans have benefited from that. The achievements include more educated populations, sharp declines in infant mortality. Here in Kenya, for example, Enrollment in primary schools has increased by 25 percentage points, and mortality for children under the age of 5 has declined by 6.5 percentage points. Africa's trade has grown rapidly. This occurred largely in response to demand from emerging market countries that overtook the advanced economies as your key trading partners, in particular because of the rapid growth in China. Africa became an important destination for capital from both advanced countries and from emerging market countries. Frontier market economies like Kenya, Senegal, Zambia, issued bonds and became more closely integrated into global financial markets. This remarkable economic achievement and improvements in social indicators occurred, I think, because of three fundamental driving factors. Let me go through that. Number one, improvements in governance that produced a business and macroeconomic environment more conducive to investment. Higher commodity prices that benefited the exporters of natural resources, especially the region's 8 large oil exporters. And accommodative global financial conditions, which boosted capital flows and allowed countries like the ones I just mentioned to tap into international markets at reasonable rates. Since all of you are studying business and economics, I'm sure you're well aware how the external environment has become much less supportive just this last year. At a global level, 2016 is going to be marked again by subdued global growth. We forecast growth to only be about 3.2% this year, barely more than 3.1 that was recorded last year. So it's a leveling off of global growth. This forecast is underpinned by important macroeconomic realignments that are underway. First, China's slowed down and it's rebalancing its economy, and that's affecting everyone. There's been a further decline in oil and commodity prices beyond what we'd seen in the previous year. Related to that, a slowdown in investment and trade, and then declining capital flows, and in some cases, capital turning and flowing in the other direction. Sub-Saharan Africa, in particular, is feeling the effects of the lower oil and commodity prices, as well as the less affordable financing terms. The result is that strong growth in recent years has decelerated pretty rapidly. Growth weakened very substantially in Sub-Saharan Africa in 2015 to 3.5%. That's the lowest level in 15 years. We expect the slowdown will continue this year with growth, we project growth at 3%. I looked back, it's the first time in over 20 years that Sub-Saharan African growth is expected to be lower than global growth. Africa had been growing faster than the rest of the global economy, and in that sense catching up. When you grow faster than everyone else, you're converging in the direction of the richer countries. But now, for the coming year, Sub-Saharan Africa is going to grow at roughly half the rate that it has in the last 15 years. Now, the current slowdown is particularly pronounced in certain countries. It's not everywhere. And those tend to be the commodity exporters. Angola, Nigeria, South Africa are among the large countries that are most affected. There are also countries that are affected by the drought in Eastern and Southern Africa, Ethiopia and Zambia. Now, when I mentioned the 3% growth forecast, it's important to say that there really is this very different experience in different parts of Sub-Saharan Africa. If you take Nigeria and South Africa out of the numbers, the regional growth is essentially 1% higher. So the quite significant slowdown in those countries and their size affects the numbers. Now, so far, the picture that I'm painting is pretty negative, but I don't think it's the whole story. In fact, I don't think it's the story at all. In fact, many African countries continue with robust growth as they had previously, 1/3 of the countries in the region are still growing at more than 5%. And this is in line with the recent trend. And here you see a slide for the oil importing countries. Oil importing countries, of course, have gained from the decrease in oil prices and have higher real income accordingly. This is particularly the case here in Kenya, more broadly in the East African community. The countries making up the community should register 6% growth this year. Growth will be high in other countries around Sub-Saharan Africa as well, Cote d'Ivoire, Senegal, and many low-income countries in the region that continue to benefit from the low oil prices. Let me say a few words about the international factors that are going to continue to affect the outlook for Sub-Saharan Africa. The commodity price shock obviously has been very severe. Crude oil prices in the last 18 months declined more than in any similar period since 1970. It's been similar for a number of other commodities. Iron ore has fallen by even more than oil. We don't really see an end to this or a reversal of this period of commodity price decline. Commodity prices are recovering a bit from the bottom, from the very low levels, but there's some chance that they'll turn down again. We expect that this is going to continue. It's closely related to what's going on in China, where the economy is slowing down. This region has always had a trade deficit with China, but during the commodity booms, Sub-Saharan Africa switched and ran a trade surplus with China. The large trade surplus has essentially gone away now that China has slowed down. And I think there's reason to believe China's slowdown is going to last for a long time. So China will remain a force in the global economy. And the process of transition, of rebalancing in China away from heavy industry and exports towards a more service-oriented economy could be faster than we've been expecting. And so the effects of China on the global economy could be quite significant. And that could mean that the slowdown in Sub-Saharan Africa could continue, could even be more severe. I think tighter financial conditions are going to be a continuing fact of life for Sub-Saharan Africa as well. There's some uncertainty about financial market developments in the advanced countries, but we think that the developments in advanced economy financial markets are bound to make money harder to come by for African borrowers. Slower global economic growth has produced this tightening of financial conditions. There's a clear increase in risk aversion that's been leading to some retrenchment of capital flows. Last year, for example, emerging market countries saw about $200 billion in net capital flows compared with, saw $200 billion in outflows compared to 125 billion of inflows that they'd had the year before. Money is now looking for safe harbors at a time when the global economy is uncertain. Should net capital flows to Sub-Saharan Africa be lower than expected, the frontier market economies, Kenya included, could face more limited external financing requirements and could find that higher borrowing costs negatively affect growth. There are also domestic and regional factors to consider. In our view, the key challenge is to implement in a timely manner the policy adjustments that are required to deal with this slowdown. Without these adjustments, there's a risk that some countries will face financial difficulties, even more abrupt adjustments. And by this, I don't mean that Kenya's in any danger. Rather, there are countries that have suffered the oil and commodity price declines have to adjust to their new circumstances. The ongoing drought in Eastern and Southern Africa is also a risk. It could be prolonged, it could be felt over a larger region. Kenya, again, is fortunately not affected. Similarly, an intensification of the security challenges in the region could have perverse effects on the overall macroeconomy, affecting trade, affecting investment, tourism, and revenue mobilization. I know you're aware of this issue as Kenya has suffered from the security, on the security front. But through all of this, with the risks that you all face, the IMF intends to continue to help Kenya, other countries in the region. We will stand with you. It's perhaps easy to look at this current situation and consider it bleak, and to worry about the prospects for Sub-Saharan Africa. But I don't take a pessimistic approach. I actually am optimistic about Africa. I hope we can talk a bit about the reasons for optimism. We at the Fund remain very optimistic about Sub-Saharan Africa's medium-term prospects. We see key drivers of growth, including an improved business environment and favorable demographics, remaining drivers of growth for a long time. But to realize the region's potential, African policymakers need to act now. This was the message in a recent report we issued. I think I saw some copies of it here, our Regional Economic Outlook. I recommend it to you. It's also on our website. As I said before, the need for action is strongest in the countries that have experienced oil and commodity price declines. Their response has been a bit behind the curve, and they're experiencing rising fiscal deficits because the revenues from the non-tax revenues from oil and commodities have fallen. They've been losing international reserves as their central banks have been trying to cushion the effect of this decline on the economies. They have more severe financing constraints, and now really adjustments unavoidable. They need to reduce fiscal deficits, and for those that are not in a monetary union, they need to let their currencies, their exchange rates be flexible, to weaken in order to provide a kind of shock absorber to cushion the effect of the lower prices on the rest of the economy. Countries that do not export commodities, including Kenya, are more favorably placed to weather the slowdown that we've seen. In many such countries, fiscal and current account deficits have been elevated over the last few years as they've taken advantage of favorable financing conditions in order to address infrastructure gaps. Your country is one example. Now it may be these countries should recalibrate policies a bit to adjust to more limited domestic and international financing options. They should use their current strength to contain increases in public debt in order to not develop debt problems, pursue prudent monetary policy to keep inflation low, and build up international reserves in order to have some cushion for future events. All of those kinds of steps will reduce vulnerabilities in the future in case there is some more severe deterioration in the global economic environment. The current situation also reminds us of the need for substantial reform in the future. Now's the time to move forward with reform agendas that will open up new possibilities for countries in the region. Countries should find ways to further mobilize domestic revenues, create sustainable tax bases from non-commodity sectors, in order to have a sound basis for the social spending and the infrastructure spending that will create a strong economy. At the same time, countries should maintain momentum toward the longer-term development objectives by better prioritizing development expenditures. The reform list is long. Economic diversification, structural transformation, financial sector development, including inclusivity, and good governance. All are more critical than ever if Africa is going to create new sources of growth and create opportunities for the people in the region to experience rising living standards during their lifetimes. The IMF's been a close partner of Africa for a long time during this journey. We're supporting the region through the rough patch that I've described. We tailor our policy advice to the specific challenges faced by individual countries. We support the advice with technical assistance and training. We have 5 regional technical assistance centers in the region. We have an African Training Institute in Mauritius that serves Sub-Saharan Africa. And as you know, we provide financial support as well, including zero-interest loans to the poorest of our member countries here in Africa. And we innovate. Kenya is the first country in Sub-Saharan Africa to benefit from a new lending product that we have. It's in essence an insurance-like product. We've given Kenya access to up to $1.5 billion that it has available on a precautionary basis that it could use if something adverse happens, if there is a shock or adverse developments, and the country finds itself in need of foreign exchange. We also believe that simply having this money at your disposal is a vote of confidence that the IMF is expressing in Kenya, and it should help you in when you are borrowing to be able to borrow at lower cost because you have this line of credit available for a rainy day. So where does all this leave us? Clearly, Africa is facing a challenging new reality. The external environment is not as favorable as it used to be. But there are still plenty of reasons for optimism about Africa. Africa, Kenya, have every reason to look to the future with a very favorable outlook. There are many steps of reform that still need to be undertaken. But previous successes here in Kenya, elsewhere around the region, show that countries can rise to the challenges that they face. I think in the end of the day, it's going to be students like you in this room who, for the next generation, are going to be the ones to tackle the challenges of the coming years, the challenges that I've been talking about. I'm sure that you're all eager to make a contribution to your country, to your region. And I think with that, your region, your country, your region can be leaders in the 21st century. Thank you.